In this episode from BMO Equity Research's Metal Matters, Helen, Amos, and Katja Jancic discuss how the outlook for metallurgical and thermal coal prices has shifted following the major underground coal mine explosion in China in mid-May, what it might take for U.S. metallurgical coal prices to close the gap with Pacific benchmarks, seasonal tailwinds for thermal coal, and implications of new U.S. government coal funding. Let's dive in.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
This week, we're going to focus on coal. It's been in the headlines since the major and sadly fatal underground mine explosion in Shaanxi province in China just over 2 weeks ago. And that has triggered a major policy response from central authorities. And we've seen immediate and widespread curtailments of coal capacity across the region. And we have already seen a decent price response in domestic Chinese coal prices, that's met and thermal, and also some of the coal exposed equities. So with me today, I have Katja Jancic, one of our metals and mining equity analysts who covers US coal stocks, to discuss how it's impacting the coal markets and equities, where is the push and pull, and how investors are thinking about this evolving situation. So Katja, thank you very much for joining me today. Do you want to give listeners a brief intro of your coverage and background?
Sure. Thanks, Helen, and hello to everyone listening. As some of you may know, I've been part of the U.S. Metals and Mining team here at BMO for over 7 years now, covering the U.S. and Canadian steel, some of the downstream processors, U.S. aluminum companies. I cover Freeport on the copper side, and as Helen mentioned, I also covered the U.S. coal equities.
Wonderful. Thank you, Katja. I'm sure we're going to have a good discussion today on coal. But before we go into that, I just want to give listeners a quick recap of the past few weeks in commodities world. So we're in early June now. The Strait of Hormuz is still effectively closed. Oil prices seem to be tracking in the $90 to $100 a barrel range. I think it's helped by some rerouting of Middle Eastern crude exports that we've seen. Also some stronger exports out of other regions like the US, Russia and Venezuela, and also some reduction in refining runs. On the demand side, we also had those large SPR releases as well. So of course, this doesn't mean that we're out of the woods yet. And the concern is, of course, that the effects of these like low-hanging fruits will wear off and commercial inventories will start to tighten again. And, you know, to be fair, inflation is increasingly showing up in official data now, and potentially even we're seeing some early signs that it's broadening to beyond direct energy costs. And that was a readout from the latest US Beige Book. Now, some cracks may be starting to emerge in some areas of the economy. So like personal savings rates in the US have turned sharply lower again. And we're seeing obviously the market price in increasing expectations of rate hikes. Yet we are in this very unusual situation of global equity markets tracking at record levels, mainly being pulled by the AI-related names, although there have been some jitters in recent days. And then on the metals and mining side, well, we're still seeing pretty decent performance, actually. So copper is trading not far off its record highs from earlier in the year. Aluminium prices, so LME and regional premia, are still making steady gains. And then nickel and iron ore prices have been holding up quite well from cost pressures and also some supply cuts that are coming through. Precious metals have been under the most pressure actually over the last month, with inflation keeping treasury yields under upward pressure. So that was a quick rundown of our space. Firstly, a fun question for you, Katja. Now, no cheating, no looking at the Bloomberg screen. So of the commodities in our coverage here, so all of the LME base metals, the larger battery metals, bulks and precious metals, what do you think has been the best performing commodity to date? So almost halfway through the year.
Oh, that's a great question. And I'm not cheating. My best guess would be the US landed total aluminum price. So when you add the LME plus the Midwest premium, mainly because both aluminum has been moving higher recently, and then the Midwest premium has been reaching all-time highs.
You know what? I think you've caught me out there. I think you might be right. So I was going to say, in terms of the metals prices on my screen, commodities on my screen, it's actually lithium, tin, and, big surprise, thermal coal. So this isn't including some of the niche critical minerals like tungsten and things like that. But yeah, you make a good point there on the delivered aluminium price in the US. Now, coals, so they were actually performing not too badly even before we had this mine accident. To be fair, we saw some very good gains earlier on in the year for met and thermal, but more so particularly relative to this time a year ago. So, Katja, you're speaking to investors all the time on coal, more in your kind of US markets. But what do you think were some of the drivers behind this improvement in coal prices since last year? And how is that showing up in the valuations of the companies that you cover?
I think some of it, maybe starting on the med side, some of it was supply chain disruptions with it, which also it's a bit seasonal early in the year. We did see a big cut to production earlier in the year. Then we have seen some delays of new capacity coming out of Australia more recently. And I do think India has been coming back to the market more aggressively versus, let's say, the past 2 years, which has supported some of the pricing side. And I think on the thermal coal side, as you can imagine, some of the push higher really started with the Iran war on the expectation that the war will lead to the energy crisis, and similar to what we saw back in 2022, higher thermal coal prices. I think those are kind of the main drivers that we've seen this year versus last year. But one thing that I do want to point out here is that while the seaborne benchmark met coal price has moved higher, the East Coast met coal index prices have lagged materially. So, for example, if we look at the high vol index, it is currently trading at nearly 35% discount to the benchmark price, versus historical, the discount was probably closer to 5 to 10%. And this is important, especially for anyone looking at the US coal producers, as most of those are very much tied to these indexes rather than fully being tied to the benchmark price. And then when we actually look at the equities under coverage, we have seen some of the met coal equities outperforming recently the underlying commodity prices. But the view here is that we will see further upside on the benchmark price, and eventually the index prices on the East Coast are going to follow, or the gap will close versus what we see right now.
Yeah, that makes perfect sense, and I agree on so many of those points. You mentioned India. I do think that was a big inflection point for the met coal market. Kind of helped met coal prices finally come out of the cost curve last year, where imports of met coal into India have finally caught up with steel production growth, if not outpacing it. And I think some of these coke import restrictions have been helping. Maybe also this PCI usage rates is plateauing. And then the one other thing I would mention, which no one is really talking about anymore, but I do think it has helped, is anti-involution. So you can see that, from the summer last year, when we started getting, for the first time in a long time, year-on-year decline in raw coal output in China, which lasted for about 6 months, that almost coincided with the time where both thermal coal and met coal prices started to improve. But you mentioned this very interesting and unusual disconnect between US high vol prices and the performance that we're seeing in the benchmark premium low vol price in the Pacific market. 35%, that's huge versus historically, as you said. And I get this question a lot as well, but how much of this is simply because we've had a couple of mines in the US of those grades ramping up, putting pressure on that segment of the market? And can you just remind us as well, what are the markets that these US coals are typically targeting in terms of global regions?
Sure. And I think you make a good point that there is new capacity being added to the high vol market out of US. We also saw some of the mines that were down last year restarting. So most definitely some of the new or restart capacity is adding incremental pressure to the prices of the East Coast indexes. But I do also think that we've seen, when you look at it, even before this new capacity has entered the market, we started seeing the discount widening for quite some time now. And some of that, in our view, is really tied to decreasing demand for met coal in Europe and Latin America, which historically have been the natural markets for US coal. So a lot of the producers now are in a way forced to export more of the material into the Asian market because those natural markets have been on a decline.
Yeah, that makes sense. And as you say, like when you look at long history of met and thermal coal prices, across the different grade spectrums, if you squint your eyes, over the broad cycles, they kind of all track up and down together. So you wouldn't expect these disparities to exist for too long. But at the same time, by no means in lockstep. And we have had these very unusual disparities at some moments, like, when in 2022, if you'll remember, when thermal coal prices were trading for a while, even above PLV, met coal benchmark price, this is following the disruptions of Russia, Ukraine, but also coincided with some new weakness in the steel sector in China in 2022 because of the property downturn. With the high vol US grades, I wonder how much changes in India are playing a part as well. I mean, India currently is taking their met coal from a very wide range of geographical sources. Since 2022, once their imports from Australia fell back, they've been taking a lot more, for example, from the US, but also from Russia, a bit more from Mozambique as well. But could it be, I wonder, that this new wave of blast furnace capacity that's coming on the west coast of India is putting like the incremental unit of demand back towards the PLV market, so rather than say US rent? That's one idea. And then I was also wondering, does it ever come up in your conversations about any potential improvement in European steel output, potentially that results from these lower quota rates, CBAM or anti-dumping duties? Could that be a positive catalyst for some of the US brands?
Well, those are all good questions and points. Maybe just on the India angle, I think in general, the expectations from US producers is that the trend that we've seen over the past a few years, where more of the US volume is going to India, but not only India, also Southeast Asia in general, where blast furnaces are still being built, that this trend will continue. So the view is that these are still the growth market for even the US producers. And if you look at just some of the historical data and you look at the data pre-COVID, so pre-2020, US producers maybe exported 5 to 10% of their volume to the Asian market. Today, some of these producers export up to 60% of their volume to the Asian, so Indian and Southeast Asian markets. The one thing that I do want to again point out here is what is a bit of a negative and maybe a competitive disadvantage for US producers is that many of these contracts, when they do sell to the Asian markets, are on a CFR basis rather than FOB, which means the producer absorbs the transportation cost, which then impacts their price realization and puts some pressure on the margins. But maybe shifting to your question about the European market, I will say that recently there has been cautious optimism that all of these increased protectionist policies should support domestic steel production in Europe and in turn also potentially help improve the demand for met coal. But there's also this ongoing discussion that if Europe continues to focus on decarbonization and force some of these producers to continue to shift away from blast furnace production and more to electric arc furnace production, that longer term, the outlook is still, let's say, a bit of a negative in the European market for met coal demand.
Yeah, very good point. I mean, that transition or that expected transition away from blast furnace to DR EAF based capacity in Europe has been a little bit put on the back burner of late. I would say a few of the European steelmakers have delayed or postponed those investment decisions, and unfortunately because of other priorities like cost competitiveness and obviously issues with trade frictions. But it's a very good point you make about the long-term story. And then on the freight cost point, that's an angle that we've been talking a lot about on the iron ore side, because again, iron ore prices are set on a CFR basis. But it's a very good point you make for the met coal producers as well. If they are selling on CFR terms, not good. Ocean freight rates have gone up substantially since the conflict started. So not good at all necessarily for net back FOB realization prices. Let's shift back maybe to the specific events in China then. So this has obviously stirred quite a lot of debate in the market. We've put out a note recently as well. So let's, I'll just do a recap now of what has actually happened, what the status is. The status is changing day by day, and then maybe we can talk about where the debates are. So what happened is that on the 22nd of May, so about 2 weeks ago, there was a major underground mine explosion at a privately owned met coal mine in Shaanxi province. This actually, it wasn't a big producer itself, but the impact was immediately quite severe in terms of closures across the province. And that's because, unfortunately, it resulted in the highest coal mine fatality rate that China has seen since 2009. Not only that, but it occurred under this newly launched 2026 Central Work Safety campaign that they'd recently just rolled out, which was, coined as by the authorities as being even more stringent than previous years. Now we've seen lots of different immediate policy implications and changes, as well as a raft of output constraints and actual closures. So what we've seen is that immediately the State Council initiated, State Council, that's the highest administrative body in China. They have been leading an accident investigation team to understand the cause of this accident. And we've seen preliminary findings from this. We've also seen already actually some revisions to mine safety standards. So they've issued these new standards with stricter criteria across 17 categories. They're particularly targeting mines that are prone, they're called outburst prone, they're high gas mines. Essex Coal thinks that those mines account for 26% of China's total output. And then we've seen extensive shutdowns for what they call self-inspection across the county where the incident happened and across the broader Shaanxi region. Now, for context, Shaanxi as a province is one of the largest provinces, along with Inner Mongolia, for domestic coal production in China. It's particularly important for met coal. It produces thermal coal as well, but it actually alone accounts for about 65% of domestic met coal production, which is why when we've had these safety campaigns in the past, it tends to hit met coal output hardest. Now, the situation is evolving by the day. So immediately, we saw estimates of 135 million tonnes of annual capacity in Shaanxi idled temporarily. That's about 118 mines. And we've seen some of these mines gradually reopening over the last couple of weeks, albeit with low operating rates. So as of Friday, we think there's 63. So the number of idle mines is down to 63. However, the pace at which these mines are reopening seems to have kind of almost plateaued in the last few days. And what we're hearing is that the mines that are still open are operating at significantly reduced rates, ceasing night shifts, which did also happen in the last crackdown in 2023. So, we're seeing basically almost continual daily gains in Chinese domestic coal prices. At the moment, domestic coal prices in China on the met side are actually still below the seaborne import price. So at the moment, there isn't enough of a pull from domestic prices to really drag the seaborne price higher, but that arbitrage is narrowing over time. And look, we'll debate it now in a second, Katja, what you're hearing, but there's different views out there, and obviously no one really knows how the government is going to respond and the severity and longevity of these curtailments. But we think, just looking at historical precedents, that it's unlikely to snap back to normal anytime soon. So we don't think the volume impact's going to be short-lived. And actually, when we look at how the authorities have responded so far, it does have strong echoes of what we saw in late 2023, when Shaanxi province embarked on major output reductions, which was result in equivalent of about 215 million tonnes of raw coking coal output curtailed over about 3 months. Now, we've also recently, interestingly, seen workplace safety elevated as a policy priority in the current 5-year plan. And like I said, this happened whilst they were already embarking on these quite stringent investigations and safety checks. So in our view, we do think that the month of June will be significantly lower in terms of mine output. And on balance, we think that there's going to be further upside in international coal prices, but particularly, perhaps the grades that have been affected by the lockdown, by the shutdown. However, it does seem that from our early engagement with investors, not everyone is as convinced on this, and some investors seem to think that actually things will return to normal quite soon. What are the pushbacks that you're hearing, Katja, in your conversations over the last couple of weeks?
I think one of the main is what you've discussed already, which is how quickly could these mines be back up and fully running. I think there is some thinking that China does not want to see prices moving up too high, especially given the war in Iran has already resulted in inflationary pressures across energy and other input and consumable costs. The other areas of pushbacks I've heard is one, India is a big demand driver, is heading into a monsoon season. So typically we would see less demand from that market. And at the same time, we've also been hearing some pushback from Indian buyers that the current coal prices might be a bit too high, given that the Indian producers are already dealing with a lot of inflationary pressures, and at the same time, they're not able to fully push steel prices higher. Some of the steel product prices, like rebar, have actually been declining. So that's one of the areas where we're also hearing that it could be a moving piece.
Yeah, all good points. And, for sure, there are offsetting factors here. I totally recognize the price volatility, energy security angle. That's obviously been ratcheted up in priorities since the conflict started. The other thing that we've been writing about is the fact that Mongolian export volumes into China are running still stronger this year, even than last year. They've been ramping up steadily over the last few years, but it seems that Mongolia is pushing even more volume out through. So, the supply context ex-China is for sure a bit different to 2023 when we saw the last major safety crackdown. But I think it all, for me, ultimately comes down to the relative priorities of the government, and how much of a deal they want to make about the standards and the fact that there have been violations. Now, the last couple of days, we've heard that a very senior government official in the county of the accident has now been subject to disciplinary action. They've found the preliminary findings from this investigation have exposed severe violations at the site and systemic failures across multiple parts of production chain. So we'll have to monitor it and day by day. Lots of moving parts. I guess the other thing, and we'll shift gears now to thermal coal, is that the setup for thermal coal was already a bit more constructive, I think, going into the third quarter, even before this happened. And, not only is demand seasonally improving as we go into Q3, it's summer, it's high temperatures. So power demand for cooling rises over the third quarter. Also, it's been in the headlines as well, weather agencies are placing increasing odds of an El Nino weather pattern. So the World Meteorological Organization, WMO, they're the latest to share these warnings of extreme weather over the coming months. So they're now estimating 80% likelihood of an El Nino event starting from June, which should drive much higher average temperatures and other extreme weather patterns as well. And I see that in India, obviously the weeks leading up to the monsoon, already some very, very high temperatures. So I think, the setup for thermal coal was already looking kind of constructive. Since the Iran conflict, even more constructive. We did hear of some of the utilities in Asia, some of the kind of traditional thermal coal importing countries, after the Iran conflict started, suggesting they're looking to use more coal than otherwise, given the uncertainty around gas supplies following the conflict. And, Newcastle active futures contract has been performing pretty well in the last few weeks. It's now breached, I see, $150 a tonne for the first time since 2023. So, and also the supply cuts in China will probably add a little bit in terms of tailwinds there. There have, I noticed, Katja, been some interesting developments in the US thermal coal market too. I noticed some headlines around potential government funding for coal plants. So what's been happening there? And do you think any of this is really moving the dial for the US coal producers?
That's a very good point. So what we've seen is that the Trump administration in general has been a very vocal supporter of coal. And we have seen multiple policies that support coal production and various orders that are directing different agencies to remove barriers and support coal-powered electricity generation. So overall, a lot of what we would see as somewhat positive development for coal demand in the US. Now, to your point, this week alone, the administration evoked a Defense Production Act powers to direct nearly 700 million of funding to coal, and this is going to be split between domestic power generation support, which includes the build of two new facilities, as well as upgrading 13 current facilities. And then there's also funding directed to building a new coal export terminal in California. So overall, what we are seeing is more support for coal. We do think that, and we've seen over the past year, increasing demand for the domestic thermal coal, but it's still longer term, it's still questionable if this is really a game changer. There's a lot of skepticism from how long these type of policies will stay in place, especially if you have change in administration. And then the other part of the conversation is also tied to the fact that natural gas prices in US are still at a level where they support natural gas power generation. It's not the same situation as we see in the global markets, which, for example, natural gas prices have increased significantly. So overall, a lot of what we would view as positive development, but longer term, from what we see so far, we wouldn't define this as a game changing for the US market in general. What we do think it's interesting is the funding that is directed to building a new coal export terminal in California. That could potentially open about 10 million tons of export, mainly from the PRB region, which is currently captive, and producers that produce there are generating very, very low margins. So a export market could potentially improve some of those margins longer term, but all of this is still very early stages.
Yeah, and as you say, probably relatively small volume impact in the global scheme of things for now. And interesting about that new export terminal too. I did notice that the US Energy Information Administration, so that's the EIA, they've recently actually put out their short-term energy outlook. They actually, despite the fact that 2025 did see unusually a net increase in US domestic coal production and consumption, according to their data, they actually are continuing to forecast annual declines to resume for both of those, so production and consumption in 2026 and 2027. So we'll see if that actually does play out that way. Now, I think we're now coming to the end of this podcast. I wanted to also quickly mention that we do cover other stocks with coal exposure here at BMO. That's Glencore and BHP. They're covered by our colleague Alexander Pierce. He couldn't join us today, but we wanted to mention that Glencore in particular has been a strong performer year to date versus the other major diversified miners. It does have the most mine exposure to thermal and met coal of the large caps, but it also benefits from coal volatility via its marketing business, and the company has already flagged that that part of its business has got off to quite a strong start in its Q1 results. So that brings us to the end of this podcast. I want to say thank you very much, Katja, for joining us today. Very interesting topics and great debate. I want to say thank you to all of the listeners. And in the meantime, I'm sure that tariff-driven news flow will be keeping us all very busy. Over the next few weeks in the metals and mining lands, we have the expected update on Section 232 tariffs on refined copper and copper products as well at the end of June. We also have Section 301 investigations ramping up. And of course, we have USMCA's first mandatory review, which is set for 1st of July.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.